as you may know, Baillie Gifford aren't really so focused on macro factors. You know, we're much more about the individual businesses that we can find and invest in. But just a small comment on the general environment in Japan that I think is particularly pertinent to a UK audience at the moment is, in terms of the overall background, I think Japan has done well so far to come out relatively lightly from the current pandemic. A very simple statistic is, adjusted for the population size, Japan has had roughly 1/30th of the number of deaths that we've unfortunately experienced in the UK. And that obviously has allowed things to keep going in a slightly better way than they have here. And also, Japan's major trading partners nowadays are significantly in Asia. And as has been highlighted in the previous presentations, Asia ex-Japan has also done relatively well. And so that's meant that overall, the situation for Japanese companies has been reasonably favourable compared with other parts of the world. Yeah, so we've got the inevitable risk factors here. And I think, you know, in general, as a very broad point, you know, we invest in equities, and as you will know, equities can be volatile and they can go down as well as up. And our general comment on all of these things would be, you really shouldn't think about investing with one of our funds unless you have a multi-year time horizon. And we'd really encourage people to think in the long term regarding investing with us. Turning to the Japan Trust itself, this is an investment trust which we think has some advantages from an investment perspective. The first of which is that investment trust can use gearing to borrow a bit of money to invest a little more in the companies that we like. We tend to be relatively cautious about the uses of this, but it can help to enhance returns over time. Also, because an investment trust is a closed-ended structure, we're able to go a bit smaller than we are with our main open-ended vehicle, the Japanese fund. And that allows us to get into some smaller companies and have a slightly wider opportunity set. And finally, over the years, it's possible to make investment trusts into quite cost-effective vehicles. And we've had a series of fee reductions over the years, and the ongoing charges at the end of the last fiscal year for the trust have now dropped to under 0.7%. And this is important for all investors, because ultimately those costs come out of your return. And so the lower they are, the higher the return you experience. And as a general comment, keeping an eye on the costs is quite helpful from an investment perspective. In terms of investing in Japan, we're very fortunate at Baillie Gifford to have a very well-resourced team. We believe that we're the largest Japanese equities team outside of Japan. At some point someone will correct me on that, but they haven't yet. And also we believe in a very long-term approach in terms of the people that we work with as well. So on the investors within the team, all of us have spent our entire career at Baillie Gifford, with the exception of Donald, who spent the first 20 years of his career at Schroders, but after 12 years working with us, we've mainly converted him to our way of thinking now. And that longevity of experience means that we all work well together as a team, even in these strange environments. And we're all focused on finding the exceptional businesses. So everyone within the team, their main job is looking for individual companies and trying to understand which are the really attractive opportunities. And we are essentially growth investors. And what that means is that we try and find the really high quality businesses, and then we try and buy the shares. We try and hold them for the long term and to benefit from that growth. And we split the portfolio into 4 different types of growth. to make it easier to understand. The first of these are the secular growth companies. These are your real high growth, out and out growth companies. Often the internet holdings fit into this area. Some of the factory automation type of holdings also fit within this bucket. Now, these are the companies that if you get it right, you can make some excellent returns. Obviously, there are also more errors made in this area because these are businesses that are operating in rapidly changing environments, and that can cause difficulties as well. Then we have a section in growth stalwarts, and these are more your kind of Warren Buffett style of growth, where what you're really focused on is the competitive advantage of the business. And you're looking for those businesses to be able to grind it out over the years. The sales growth might not be super fast, but what you can do with a really good quality business is you can steadily increase margins over time and generate quite a rapid rate of earnings growth. Then we have some special situations, and these are ones where we like the underlying business. There's also a big anomaly with regard to the market price compared with the underlying assets. So often there are some big equity holdings or some big amounts of cash, which is very common in Japan, that we think are not fully understood by the market. The difference between us and a value investor in this area is that we only invest in these companies where we like the underlying business. It being cheap is not good enough for us. We really want a good quality business to be core to the case. And then finally, we have a group of what we describe as cyclical growth companies. And these are companies that peak to peak or trough to trough, we expect to deliver faster than market earnings growth, but they can have a significant element of cyclicality to them. And in a similar way to the example shown in the earlier presentation, what we're trying to do is to get those companies when things are difficult, and we think about perhaps moving on when conditions are better. And by having these 4 different types of growth within the portfolio, it gives a bit less of a kind of single style effect to the portfolio. And it means that we're a bit more resilient to different market conditions. Nonetheless, clearly, with 45% almost of the portfolio in the secular growth companies, we are firmly in the growth category. And then the next slide is quite important to us as well. Many investors will say that they are long-term, but we genuinely are long-term. This is the turnover for a year on a rolling basis of the Japan Trust. And you can see that recently we've been getting a bit excited, and maybe a bit over 15% of the portfolio has changed this year. But there have been years when well under 10% of the portfolio has changed. And what that means is year to year, 85% of the portfolio or more is generally the same as the year before. So what we try and do is really focus on the really exciting companies. And once we've identified one, we put it in the portfolio, and then basically we try not to fiddle. And this doesn't sound very sophisticated, and in many ways it isn't. What we're doing is trying to get the companies themselves to generate the returns for us, rather than try and do a lot of trading in and out of things. In general, what we're doing is trying to find the businesses we like, holding them for the long term, and letting the businesses do the growth. And I think as a general rule of investment, much though it may not suit the brokers, and as a general rule of investment, having lower turnover generally results in less money going to the brokers and more money staying with yourself. And I think that applies both to us as institutional investors and to you as individual investors. And then in terms of thinking about how Japan is getting on at a corporate level through the pandemic, we've been quite pleased to see how resilient Japanese corporates have been. So here in the purple bars, you can see the dividends coming from Japanese companies. And you can see they're forecast to fall a little tiny bit this year. And that's because Japanese companies run with generally a pretty conservative way of doing things. The reason for that is many Japanese companies are prepared for natural disasters such as earthquakes and so on. And so over half of the index in Japan has a net cash position, and we're a bit ahead of that within our portfolio. And what it means is when times get tough, the dividends don't get slashed in the way that perhaps they have unfortunately been in the UK market. And in terms of the performance, how things have been going over the years, I think reasonably well is the summary here. So the green bars are the cumulative return from the topics index, and the purple bars are the NAV total return achieved by the Japan Trust. And there's a decent gap between the two over each of these time horizons. And also because this is the NAV total return, it takes into account those ongoing charges. So this is after all the fees. Now, obviously, there's a very important point here that past performance is not a guide to future returns, but those are what has happened in the past. And the board was pleased this year to be able to declare an increased dividend, which I think, again pays testament to the resilience of corporate Japan, that actually the earnings were increasing in the trust fiscal year to August, and hence the dividend could be increased for the trust shareholders. Now, what's driven the returns? This shows the returns, the main contributors over 5 years, and in general, 5 years is really, in our view, a sensible time to think about investment. And what you can see is it's a mix of different things, both on the positive and the negative side. Many of these are not household names. Softbank, I'm sure you will have heard of, but others are quite not well heard of here. But for example, Yaskawa is a robot company, M3 is a medical website, and there's a variety of other things within there. And what we try and do is capture the asymmetry of returns, i.e. to make more when we're right than we lose when we're wrong. And you can see that happening here with the bigger contributors on the positive side being, roughly at the top level double or higher than the costs when we get things wrong, as we inevitably do on individual holdings on the bottom side. Now, turning to the last year, it's been an interesting year from an investment perspective, driven by the pandemic. And really what you can see in the past 12 months there's been a very strong tilt towards the so-called pandemic beneficiary stocks, which is quite an awful term given the human costs that have happened. But what we've seen is it's really been the internet businesses, things like Softbank and CyberAgent and GMO Internet, and Demi-Can, which is a bit like Just Eat in the UK, and Sysmex, which is a medical website, that have really been driving the returns on the positive side. And some of the real world businesses like Inpex, which is an LNG company, or Sato, which makes barcodes, or Mazda, which makes cars, those are the ones where times have been more difficult. Now, over the longer term, we would expect things to return more to the situation of the 5 years and get returns from different areas, not just the internet area. And looking at the current positioning of the portfolio, we continue to have a lot in the internet related areas. So Softbank is a big internet company. I'll go on to speak a little more about that because it's regularly in the news. GMO Internet is an internet conglomerate focused entirely domestically. Rakuten is mainly an e-commerce type of company, so a bit similar to Amazon, but Japan focused. And those are the biggest holdings in the portfolio. But in general, we run quite a diversified portfolio. It's unusual for us to have a single holding over 5% of the fund. Softbank is there through its own efforts in recent times. And in total, we have, a bit over 25% in internet-related businesses, and another nearly 15% in automation-related businesses. Now, these automation-related businesses are really the robotics companies, and we think that these are very exciting in the medium term, but they haven't really been flavour of the month recently because, again, these are real-world businesses, but we're enthusiastic about them in the longer term. And so looking at Softbank briefly, now many people are a bit scared about Softbank, and they hear terrible things about WeWork, for example, in the past. But the reality is that Softbank, the majority of the value of Softbank is Alibaba, which is the leading e-commerce company in the largest market in the world, being China. WeWork mainly sits within the Vision Funds, SVF1, and is a very small proportion of the total exposure of Softbank. And we think that Mr. Son, the founder and big shareholder in Softbank, is very value added as a manager in the medium term, and we expect him to continue to do well. And in additionally, the shares currently trade at about a 30% discount to the value of the holdings less the debt. So we think we've got a really interesting combination here of good assets, a good manager, and a big discount. And it's interesting, if you just look at the UK news, you would tend to think Softbank would have been a terrible thing to invest in over the past 5 years. But actually, it's delivered a compounded return a little over 30% per annum over the past 5 years. So Mr. Son has continued to get richer, and fortunately, it's been helpful for the shareholders. Looking again to the future, we're continuing to see big opportunities in disruptive businesses. These generally fit within that secular growth area. And we think there's a big amount of change going on in the world, and that gives us loads of opportunities across a whole variety of sectors to see internet-type businesses come in at lower cost and often offering a better service, and many of those doing pretty well. Now, this isn't a new theme for us. This has been something we've been invested in for many years, but it's perhaps become more salient in recent times. Also, within the car area, Japan famous for its cars, but a lot of things are changing about cars at the moment, and we're seeing those changes come through in the opportunities that are available to us. And so we're slightly changing some of our emphasis on what we're investing in and getting, in general, more interested in components going into cars than the whole car assembly. And so, for example, things like Denso makes a lot of the electronic systems and the electric parts that go into Toyotas. Or Bridgestone makes tires, and it doesn't matter then how your car is powered, whether it's with a battery or something else, or whether you drive it or it drives itself. At the end of the day, the car still needs the shoes in the form of the tires, and that will be the case regardless. We've had a lot of talk earlier in the sessions about valuation, and we very much are growth investors. And that means we like to invest in the high quality growing businesses. But it doesn't mean that we don't pay any attention to the valuation. And you can see here that actually the overall valuation of the trust is not so different from the wider market. We're paying a small premium in terms of price to book or price to sales, but actually a small discount in terms of EV to EBIT. So all in all, what I think is quite exciting for us is we're in a position here where we've got over 40% of the portfolio in internet and robotics related companies, which seem to me quite exciting, but we're not paying a big premium to have those exposures. And that encourages me when I think about the future. And this next slide really highlights what we've been doing recently. And those are the kind of purple coloured stocks at the end. This is what we've been buying in the past year, and a mix of different things there. I've talked briefly already about Denso and Bridgestone in the car-related area. We've also bought a company, Tsubaki Nakashima, which is a leader in ball bearings. And each of these companies they do have some element of cyclicality to them. They've been a bit depressed recently, and that we think creates future opportunity. We've also taken some holdings in some eclectic things. So Polar is a high-end skincare company. Calbee makes snacks, and Sugi runs a pharmaceutical chain, so a bit like Boots in the UK. And then we've also taken a holding in something called Bengoshi, as it's pronounced in Japanese, or Bengo 4, as you can see there. And that runs a business called CloudSign, which is very similar to DocuSign in the West, so benefiting from a move towards electronic signing. So a mixture of different things being bought there, but actually the only internet-related thing in that list is actually Bengoshi. And so we kind of cast our net fairly widely in terms of the new ideas. And again, to re-emphasize, where we like things, we do hold them for a long time. So about a quarter of the portfolio has actually been in there for over 10 years, which I think is quite unusual in the investment world. But if we're still happy with it, we're quite happy to keep it. So in conclusion, I think we've got a pretty resilient process with a stable group of people. I think the portfolio has different types of growth in it, which should give us a bit more resilience in different conditions. And the historic performance has been decent. Currently, I think we have a mix of high growth businesses, but without paying a big valuation premium for them. And we're continuing to find a good number of new ideas. So overall, I think it's a fairly encouraging time to be a growth investor in Japan.